We do see what is set to be a strong finish to round out this week. Joining me now with more is Ben Emmons, founder and CIO at FedWatch Advisors. Ben, it's great to see you.
Good to see you, Kristen. Good morning.
How are things looking to you as we get started in 2026?
I think it looks pretty bullish. The recent data that come out the last sort of 2-3 weeks shows like one data firming after the other. And yesterday was very encouraging. Regional data also really strong. So it shows that the manufacturing sector is also pulling out of the slump, and the services sector is already holding up because of all the spending that consumers are doing. So I think we'll continue the bullish tone from last year. It's not going to be a year where we shift back to a really negative economy. In fact, actually, I think the economy will grow more faster this year than last year.
What data is most important to you in terms of painting the picture of what the economy will bring us?
Well, investment, that's key. Like when you talked just now about TSMC making $250 billion investment here, or a commitment, the White House has a lot of commitments, and that's 10, 20 times as much more than the previous administration. Not to be political, but from a macroeconomic standpoint, if most of that investment actually happens, we're going to be growing for several quarters, if not longer, at least 5% real GDP. So investment is really key. I think it will happen. I do believe this administration is very different than previously. It's going to go after making sure these investments happen. It will be very significant for the economy.
And of course, the Fed does have a rate decision due at the end of January. It's first of 2026. What's your expectation for the path forward for borrowing costs?
So there are two things happening there now currently, right? One is that we're dealing with an economy picking up, with inflation staying above 2%, well above 2%. So a lot of Fed members will say there's no need really here to move interest rates at this point. They're not as restrictive anymore, but we cannot really bring rates much further down or we get inflation. So that, I think, is one view. But then we're having this developments that just happened over last weekend with Powell's position in play. That will make this press conference interesting because there's going to be a lot of questions about it, of what he will do when his term is up. And that is important now because there's going to be delay potentially of this next Fed chair nomination. At least that's the signals that are coming out of D.C. So for Fed policy, that begins then to matter because not only that they may stay on hold, but it's also about this leadership shift, change, and that makes things uncertain, meaning they don't make any decisions as a result, and that's meaningful to markets.
Yeah, let's talk about yields and what you expect there. Of course, gold has been a commodity in focus as well. How does this impact those markets?
Yeah, gold is interesting. It's a hedge that people want in their portfolio because we don't know what's going to happen. Whether they were going to get a strong economy, yes or no, investment, yes or no, what happens with Powell and so forth, or with Venezuela and Iran. It is a geopolitical year. It's really shaping up that way really quick, and it probably will stay that way. So headline risk leads to higher gold prices. That I think. But with yields, it's a different story. Very range-bound, awaiting, I think, one, what the Fed will do, and second, this economy that I described. I do think will break out because if the economy gets stronger, yields are going to go higher. It won't derail the stock market, but I do think that gold prices will eventually taper off when that happens because when the good scenario starts to dominate, the geopolitics and headlines matter less. So I think gold has at some point a peak in this year. And I think that will be a change.
Yeah, that's because we've seen gold up double digits last year, right? Silver was up triple digits. So interesting to follow that commodity space indeed. So the Monday, the market is closed, of course, for a holiday. But then after that, we're going to see the World Economic Forum over in Davos, Switzerland really get underway. Is there anything that you're watching for to come out of this year's Davos event?
So one, President Trump will be there, which has not happened for a while. And that is interesting because he's on the international stage there, really making, the big case about the U.S. and the best economy and all that sort of thing. At the same time, we have the Supreme Court deciding on the tariffs, potentially, next week again, is opinion day. And then there's the hearing about Lisa Cook and what that all means. That all comes sort of together in 1 week with GDP data and PCE data. So Davos has always been a contra-indicator to me. Like when everybody's very optimistic there, it tends to be a different scenario in the markets and vice versa. we're in a geopolitical year. I think Trump's presence there will be more headlines, and therefore not necessarily everybody will be so optimistic, driven by those headlines. So good for the markets, but it is an interesting week as we get into it. So it's economy on display plus the Supreme Court. I guess what we're getting out of Davos is more of a picture about what Trump's intentions really is, like Greenland and Iran and Venezuela, and what this means for the U.S. economy.
Now, when it comes to the U.S. economy, the other factor that I think market participants are watching closely is the Supreme Court's ruling on U.S. tariffs. We have yet to hear from them, but do you think that the market has absorbed any tariff-related costs? And what about the economy?
Yeah, it's a difficult question because there's risk here. We've not only used those tariffs for our deficit spending, have used the tariffs for negotiations, for geopolitical reasons, for security reasons, and then obviously the refunds. Now the refunds, that's a very mechanical process. It will take years. But people have said, look, it will impact deficit expectations, so interest rates could react to that. Second, because it was a really flexible tool, is a flexible tool for President Trump to put on and off at any moment, that's kind of taken away if they rule that it's not the way to use these tariffs. So it's an interesting decision. It's also notable that the Supreme Court cannot make up its mind yet on this topic. So there's a lot of talk in the market that they may not at all. They just take much longer time to make eventually the decision, which gives the administration time to work in the other tariffs so that we don't deal with this issue about a sudden uncertainty how these tariffs can actually be used. I think that's what's sort of driving the market currently. Otherwise, there would have been more volatility.
Ben Emmons, founder and CIO at FedWatch Advisors, joining us here in 2026 ahead of Davos next week. Ben, thank you.
Thank you, Kristen.
Great
Good
to
be
have
here.
you.
Yeah.